Hello, my name is Michael Duke, and this is the show where I discuss interesting stocks. So if you find that interesting, then please consider liking this video, subscribing to my channel so you see more. Uh, Today, I want to discuss Nike, ticker NKE. We all know Nike. If you don't, you should. Very iconic company. You see, as of recording, it's March 21st. So today we're going to give our usual overview and analysis of the company, but we're also going to take a look at the earnings report that they released yesterday. I'm going to give my thoughts on it. I'm going to grade the company. We're going to do some technical analysis as well. Um, and discuss some of the risks in a potential investment in the company. So, as always, not financial advice. Goes without saying. Um, so yeah, let's get into it. Nike, of course, is an athletic apparel company. Some of their brands you see: Nike, Jumpman, Converse, Chuck Taylor, All Star, One Star, Star, Chevron, and Jack Purcell. Um, very, very iconic brand. Of course, the company is consumer discretionary categorized. Now, you should know that this is about to be a very biased analysis. I don't like discretionary companies. I don't like discretionary cash flows, uh, especially in the environment that we're in now, where there's a lot of uncertainty. Uncertainty breeds caution, breeds lower earnings, revenues, yada, yada, yada. Let's take a look at a few things. Obviously, company has not performed well. It's basically down 70% from an all-time high in late 2021 of over $170 a share. So, does the company have a moat? Well, yes. Companies like this, branded apparel, um, sure, there's a wide moat. You have iconic brands, iconic intellectual property. Um, yeah, intangible brand assets are the moat here. However, the moat that they have doesn't stem from tangible assets like other companies I've discussed, such as Republic Services, stuff like that, where what they own is the basis of the moat. So while they do have a wide economic moat, that does not necessarily insulate them from periods of weakness. To further that, let's take a look at the Morningstar report. Morningstar is saying that the company is significantly undervalued. It gives it a 5 out of 5 rating. They grade wide economic moat. David Schwartz wrote on the 2nd of January, we assign a wide moat rating to Nike based on its brand and tangible asset. Nike is the world's largest athletic apparel and footwear company with global operations. Sales have increased in 13 of the past 14 years. We're going to see if that's still intact here in a moment. As evidence of its competitive edge, Nike's adjusted returns on invested capital have averaged 35% over the past 5 fiscal years, well above our 8% estimated weighted average cost of capital. Morningstar has this analytical approach when it comes to moat, where they ascribe wide moat to excess returns on uh, invested capital in the long run. Um, I see that more of an outcome of a moat rather than, I don't even know the right word to assign it, but um, I guess they are saying that's evidence. In addition to quantitative factors, we evaluate activewear producers like Nike using 5 specific criteria: geographic reach, pricing, sponsorships, product quality, and control over distribution. You see here a lot of these apparel stocks pretty undervalued. Let's talk about narratives driving the price. As for why this company is sold off so much in the last few years, well, you had kind of a broad ranging uh, bear market here, but the company hasn't really recovered from that. We're going to discuss that. If I had to guess what is driving the price, I mean, they've just seen. I've never analyzed this stock before, by the way. So a lot of the companies that I've covered on the channel, I have analyzed them prior. Never analyzed this one. So let's dive into the financials. This might give us an idea of what's going on. So over the last 10 years, revenue from 30.6 billion to 48, that's roughly 30%. That's like a low mid single digit compound annual growth rate. We see here revenue has tailed off the last several years. In fact, we're dipping back over the last trailing 12. And I don't know if this includes our most recent quarter. Revenue's coming back down closer to where it was seen in May of 2022. And to that end, uh, gross profit 14 billion to 21 billion. That looks good, up 50%. So we've seen some margin expansion, but we also see gross profit trailing off. Operating income from 4 billion to 5.3, only up about 30%. And though over the trailing 12, operating income is the lowest since May 2020, actually edging down to May 2019. Doesn't look good. However, it is up again 30% roughly in that time frame. So inconsistent operating income, gross profit, and revenue over the long run have looked great. There's an issue happening the last several years. What's going on? And again, earnings from continued operations also up and down, but trending up. Looks like they have bought back a decent amount of shares from 1.7 billion to 1.5. Not bad, just a little over 10%. Dividend growth. Don't know if this is split adjusted or not, but we see from, I'll just go here to May, 54 cents a share to $1.45, almost 3 times. So our payout ratio should be going up. Payout ratio should be going up because our earnings per share diluted only up about 50%, but our dividend per share up times 3. Our shares are getting bought down. Does appear that our shareholder returns might be excessive compared to the underlying business performance. If we take a look at the balance sheet, 3.8 billion of cash, 8.6 billion. Um, no concerns noted there. Inventory, 4.3 billion to 7.5. Nothing really concerning about that. Nothing really sticks out. If we look at long-term debt, however, we do have a pretty large increase in May 2020. I wonder what's going on there. Yeah, we see debt has ballooned from 1 billion 10 years ago to 8 billion today. They have paid down some of the debt. It looks like it did balloon in 2020. Makes you wonder what's going on there. So while our cash, I mean, it does appear that they just pulled cash. They could have just raised cash through that debt financing, sat it down. Perhaps they did a levered buyback and a dividend recap with some of that debt. Either way, kind of inconclusive by looking at these top-down numbers. However, I don't see any major concerns because, again, our long-term debt being 8 billion versus 8.6 billion of cash, they have significantly increased their leverage in recent years, but it's still they still aren't highly leveraged, still have a pretty liquid balance sheet. Not to mention that they have 7.5 billion of inventory. Okay. So they have plenty of current assets. So no major concerns with the balance sheet. However, the income statement, something is going on here that I'm now going to attempt to explain. So this dropped yesterday. Okay. Um, I'm looking at this for the first time. Third quarter revenues were 11.3 billion, down 9% on a reported basis compared to the prior year, down 7% on a currency neutral basis. 11.3 billion in the third quarter. Let's annualize that. 11.3 times 4 is 45.2 billion. So that's further deceleration, 45.2. That would be the lowest revenue since May 2021. Okay, not good. Nike Direct, not sure what that is, but I would maybe assume that it's some sort of e-com deal. Nike Direct revenues 4.7 billion, down 12% on a reported basis, down 10% on currency neutral. Wholesale revenues down 6.2 billion, down 7% on a reported basis and down 4% on a currency neutral basis. Gross margin decreased 330 basis points to 41.5%. Yikes. However, those gross margins are still pretty good. We do have the recent quarter uploaded. So this gives you an idea. I assume that these numbers are included in the annual or the trailing 12. I'm not going to calculate it. I don't have time for that. However, we do see here that this revenue number is the smallest out of any 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 out of the last 12 quarters. This is the lowest revenue amount and the lowest gross profits. One thing that would be interesting, again, I don't necessarily have time to do this on camera, but what is their gross margin in this quarter compared to the others? 330 basis points is a lot. 54 cents a share. That's 31 times earnings on the recent quarter annualized. It's not looking like a good value, folks. Gross margin decreased 330 basis points, primarily due to higher discounts, higher inventory obsolescence reserves, not sure what that means, higher product costs, and changes in channel mix, partially offset by restructuring charges. SG&A decreased 8%. In other words, they're laying people off, cutting leases, selling, downsizing their business in anticipation or in reaction to declining revenues. We see here operating overhead expense decreased 13% due to restructuring and lower wage related expenses. So demand creation expense up 8%. Marketing expenses are up. Operating expenses are down. Diluted earnings per share decrease of 30%. Net income 800 million, down 32%. Inventories only down 2%. So they haven't been able to move inventory as quick. It's hard to, in my head, do a second order calculation on inventory. In the third quarter, company returned 1.1 billion to shareholders. Dividends up 594 million, share repurchases of 499 million. This isn't apples to apples, but we see here net income 800 million and our dividends and share repurchases were 1.1 billion. So if you're a shareholder, okay, you're receiving that coupon. Our dividend yield is 2 something percent. You're receiving that coupon. It grew, they gross dividends of 594 million, dividend per share, however, that's what, 7% increase. So what I'm seeing here is that the shareholder returns were more than the underlying business performance. I really don't like that. I mean, maybe you have your own ideas. Obviously, if I'm a shareholder, I'm being enriched through dividends and share repurchases. By the way, I don't have a position in this company. Just want to make that clear. So I'm being, having capital returned to me. Great. However, that's in excess of net income. Not a good sign. Doesn't mean that it's bad. But if you're looking at, I really think that investors overlook the total shareholder yield payout ratio. It's really easy to come in here and look at this and say, "Oh, yeah, they've been paying out 30 to 50% of their earnings as dividends." Well, what happens when you include share repurchases? You see that their payout ratio is in excess of 100%. I don't like to see that as a investor. I don't like that. Um, so the finances of the company don't look great. As for why, this is interesting. You see, this is quarter in the quarter, year over year. North American footwear down, apparel up, equipment up. Uh, all three segments in Europe, Middle East, and Africa down. All three segments in China down. All three segments in Asia, Pacific, and Latin America down. And that's just Nike, but then you also have Converse. Not good. What is going on? I really don't know, but it doesn't look good. So let's take a look. We already alluded to this somewhat. Let's take a look at the valuation. Um, we see again. I calculated a 31 times annualized recent quarter earnings. Smooth that out a little bit on a trailing 12. The earnings were higher, right? So it's 24 on a forward, estimated to be 34 times. Price earnings growth. Well, there is no earnings growth, right? So our price earnings growth is nothing. Very bad. There, it looks like analysts that are flowing through this platform, assuming some modest earnings growth in the forward. I have no reason to believe that that will happen. By pretty much any sort of metric that you dice it, this stock is still expensive. Price sales being 2 times, that's probably the least offensive metric. Um, and far above book value. Not much to discern there. Uh, so because we have a shrinking business with shrinking margins, our valuation grade, of course, is not good. It doesn't look like a value to me whatsoever. And we're going to pull up a chart to verify that. One thing that does make it look like a value is that it's trading at the highest dividend yield it has in 10 years. So, on a yield basis, it does appear to be a good value now. However, when we're looking at the rate of shareholder returns, that they're excessive at the current levels now, that does leave some concern. I would prefer my company to not buy shares when we don't have the profits to justify it. They're taking money off their balance sheet to do it, and they have plenty of money on the balance sheet. Okay. So it's not like they can't afford it. Let's take a look at the valuation over time. Again, this is price earnings gap on a trailing 12. So from that standpoint, there's nothing discernible there about it being over or undervalued. You see these periods here um, due to poor earnings. We will see this number balloon as, again, price earnings gap is a backward looking metric. Um, if we can look at price cash flow again, backward looking, same story. So these numbers don't look bad at all if you're looking at this. However, you need to be looking at, you need to be looking at forward metrics. Let's take a look at gross profits because that was a concern. They said gross margin to 41.5%. That's not quite reflected here because I think this is an annualized. That is the lowest that we've seen since 2003. Yikes. One thing that I will say in the company's benefit is this chart here. Um, it might be on an annualized basis. Perhaps we've had quarters throughout here that are lower. Unclear from this data. However, if we go off this data here, yeah, that's lower than we've seen in quite some time. So while we did talk about how the company has a strong moat, gross margin is a evidence of moat. When gross margin is going down significantly, the company might be doing that intentionally or not. Yeah, that's not good. That'd be the lowest level we've seen in 25 years. So that's concerning, I think. So on a yield basis, again, we're, free cash flow yield um, looks good in a trailing, doesn't look good going forward. So while the yield might be higher today than it's been in quite some time, it's not looking like a value to me. So let's discuss the risks of an investment here. Well, I think what I'm looking at is there's a fascinating um, piece in investor behavior. If you've been investing in stocks and you keep up with the media of which I'm a part of, you notice that you look at a chart like this, right? Nike's a very visible brand. I've been buying their products for years, ever since I was a kid, right? Grew up with this company, very visible company, right? You see, it has been a good investment over time. You see, it's up 2,800% um, since 1995. That was when I was born. Um, so it's done well. When you see a chart like this, the brain screams by the dip. It's down by the dip. However, it looks backsliding and it looks sketchy because earnings are going down and the PE ratio is not going down. Okay, so it doesn't look undervalued. I think the biggest risks that we have tied up in this is it's a cyclical stock. It's a consumer discretionary stock. So when consumers are tapped out and they don't have all this extra money because wage growth has been slow or inflation or you name it, their confidence is low, they got laid off, whatever. When the economy is bad, this stock will not perform well. Okay. And it hasn't been performing well. So you have this kind of double whammy of the not only is there a macroeconomic element that leads this company to trade poorly versus the relative market in times of weakness, but it also has been underperforming its own benchmark. It indicates to me that Nike is losing market share. Okay. I'm not looking at the consumer scan. I mean, I'll just look it up. Is Nike losing market share? So we have sources cited here. So according to our source material here, as it faces growing competition from On and Hoka. So as somebody who runs consistently, I still purchase Nike shoes to run from time to time, but I don't really have a strong affinity for one brand or another. I consider shoes to be a little bit more commoditized than maybe the professional analysts elsewhere would. However, one thing I do know is that my wife buys these shoes and swears by them. Says other shoes make her toes go numb when she is running. So, look, the data is inconclusive here, but what I see in the financials is that one of two things is likely true. Either the global economy sucks, which arguably it does, or Nike's losing market share, or both. Either way, I don't like what I'm seeing. It doesn't look like it's a good place to hide right now. When I believe that the market is uncertain about the forward, I want to have my capital allocated in good places to hide, as I call them. So that's the biggest risk factor here that I see, is that it's just not a good place to hide. Of course, you also, as it goes without saying, you have currency risks. So out of 11.2 billion of revenues, you had 4.8 in North America, 2.8 in Europe, Middle East, and Africa, 1.7 in China, 1.5 in the rest of Asia. So you see here, less than half of their sales are in dollars. If if you're expecting periods of dollar weakness or strength, you know, marginal impacts to the stock, but currency movements, particularly drastic currency movements, will impact the stock. You see here um, that on a trued up basis, this percentage change includes currency. We see that sales declines were more volatile due to currency exchange rates. In fact, they were 300 basis points worse due to currency risk. So when the dollar is really strong and it's getting stronger, it's bad for for shareholders in Nike. The dollar has gotten weaker in recent months, so I would expect their upcoming earnings. I would have expected more out of their earnings. The fact that it's even worse is double concerning. Let's take a look at their chart here for a second. Doesn't look good. I mean, we're kind of there's a clear pattern here. There's kind of a downtrend area there, and these lines are approximate. So here, this period here was kind of when the bear market reversed. Like in broader stock markets, we had from this point to this point, all stocks were more or less either trading sideways or trading down. The entire market was trading down a little bit. The stock recovered, but I think what the market started to catch on to is that just weak underlying business performance, and the stock continues to be in a downtrend. Now, each of these candles again is a week, so we're in the current week. Every time the stock has been on the verge of a breakout, the stock did break out here, but got sized back down. And you see here, very significant, but has been able to hold this support line. Again, very, very rough chart, very, very weak lines. But I think it's pretty easy to see that the company is in a downtrend. So when we're talking about it trading out, what are the catalysts? What are the catalysts for it breaking out of the downward wedge? Earnings have to normalize. We have to have good economic news. Again, this company is trading. It appears to be correlated highly with the S&P, and yes, significantly diverged. from this prior period of outperformance. I just macroeconomically, I don't see there being a catalyst for the company. So you're getting hit on all fronts. Not only do you have, um, you know, weak economic outlook and backdrop, um, but you have market share concerns. So it appears to me that the stock can continue to fall. In fact, I would expect it to trade down to at least 60-ish dollars a share from where it is now. That's another 12, 13%, 15% almost from where it is now. So it doesn't look good. So what do I grade it? Guess it goes without saying. I'll grade this as a sell, or more appropriately put, an avoid. Okay. I would avoid something like this, because not only does it does everything look not good right now, but I fail to see where the catalyst is. If I contrast this with a stock like Hershey, which I've covered before, I've given that a buy in multiple videos. Um, Also, a stock that's in somewhat of a downtrend. However, the behavior of the chart, it's much more consolidated along a base in multiple periods. There is a very clear and present future catalyst with a company like that. If cocoa prices revert to historical mean, then there's a clear catalyst that I believe will launch the stock price out of this range of defeat. Here, I can't articulate easily what that is. So for me, it's an avoid. If you have a well articulated thesis as to why it's going to break out, please share that, comment that below. I'd love to hear it, love to engage with that. I don't see it. Nike, we took a look at their earnings report. Doesn't look good. We didn't dive too deep into it. I didn't really dive too deep into what the company does, because I think it goes without saying, if you don't know what Nike does, you should. Doesn't look encouraging. So I've never owned shares in this. I will continue to avoid. Um, I don't see any near term catalysts. So that's the video for today. Hopefully, you found this entertaining and useful. I've certainly had fun. And please consider liking the video, subscribing to the channel, engaging with me. I really appreciate you for watching. And we will see you next week, because it's Friday and it's the weekend. And we'll see you. Thanks for watching.